Hi, I'm Steve Van Metre, and welcome to your weekly economic update. Man, I have got something really cool to share with you today. And in fact, it's so cool, I didn't even think I'd ever be able to create it to show you. I was totally relying on other people. And it occurred to me one night, I probably have the data, or I probably could get the data. And man, I got it. It's super cool. You're going to love it. It's all about world dollar liquidity. And man, but before we get to that, let's talk about what's going on. Because right now it seems like stock mania is back, and the question you always have to ask when you see these big bear market rallies is, what's changed? So, because not much. I mean, did the economic data get better? No. Did it get worse? Yeah, and did it get worse by a little bit? No. Did it get worse by a lot? Yeah, it did. And you'd think that people wouldn't be jumping into stocks given this horrible data. I mean, I'm going to show you, it's not pretty what's going on. Unless all these people think the Fed's going to go tuck their tail and run and support asset prices. But again, this is the inexperience of, unfortunately, my industry. Not to mention all the people, the big money managers that are over leveraged. I mean, they've borrowed so much money and taken such speculative positions that they can't see the market drop. The Fed never backs down until it's too late, ever. Go look at history. It's not until it's way too late, until Wile E. Coyote is maybe off the bridge, off the cliff, looking down and goes, uh-oh. It's not until then, and when that day comes, it's too late. It doesn't matter what the Fed does. It doesn't. So, stock prices have gone up. Why? Corporate share buybacks are running at a 78% increase over this time last year. Staggering. Why would corporations do that? Is it because they're committing more money to share buybacks? Not really. Not really. So why would they do that? Well, what if you were a CEO or a corporate executive of a major company and you had boatloads of stock options and company stock in your portfolio, maybe potentially worth, hundreds of millions of dollars, maybe billions, who knows? Wouldn't you want to sell it? Sure you would. And why would you want to do that? Well, it's very interesting. The Trump administration was touting how great the January jobs report is. At the same time, they said that the December retail sales report was a glitch. Well, how could that be? Because industrial production came out today and it validated the December retail sales number was legitimately down. So what power do corporate executives have of these major companies? They know data in real time. That's what it is. You want to be the smart money? Get to the point where you see in real time tick sales data and you're like, wait a minute, this is not good. This is not good compared to last week, last month, last year. That's where the smart money plays. All these big money managers that have connections to these corporate executive teams, they know what's really going on. And when you're the CEO of a major firm and you got boatloads of stock options and company stock because you've cut your salary down to a negligible amount to trade in exchange for big stock grants, you need to get your money out. And how do you get your money back? You simply go to your board meeting and say, we're going to buy a bunch of stock back. What's the board going to say? Nothing, because they have no legal authority to stop you. So you call up, major broker firm, say, hey, we're wiring you over, tens of billions of dollars, buy. And oh, by the way, when you start buying, I want you to start selling off my stuff. Yes, sir. You got it. So that's the only thing that changed. So what's the accelerate? Why are these corporate executives accelerating this? Because they know what the data is in January. They know it already. The government hasn't published it, all of it, because they're still catching up from the shutdown. So all of this stuff that's been going on behind the scenes has been under this cloak of secrecy from the government shutdown. And corporate executives know the global economy is slowing, sales are slowing, and as soon as people figure this out, stock prices are headed down no matter how much stock is bought back. So we better get what we can while we can do it. That's the only thing that changed. Now, from the public standpoint, well, price is rising. Well, great. Price can go up for periods of time, but it can also go down really rapidly when the truth comes out. And so when you see these bear market rallies, and we are in a bear market because we haven't had a new high since October, which is pretty unusual in bull markets. You don't normally get these long extended pauses before, and we're not even still back at all-time highs to begin with. So when you get these bear market rallies, what does it do? It tells the public to get back in. And again, that's what these big players want. Money coming in so they can sell. Because if corporate share buybacks are indeed up 78% over last year, which they are, why aren't we at new all-time highs? Shouldn't we be? If the big money managers are buying, and the smart money was buying, and the public was buying, and corporations are buying, we should be way over last year's all-time high. And we're not. Plus, the Fed is not stopping. There's been no indication, none whatsoever, the Fed's stopping. Yeah, they're jawboning, and that's their job, is to try to, give people faith in the Federal Reserve System, which nobody should have faith in because it's never worked. But that's their job, is to defend what they're doing. And they're continuing to unwind their balance sheet. There will be no change and no decision on it until March. And based on what we've seen from the Fed speakers, there's not going to be any change, maybe for a couple of years. Of course, that means we'll be in a recession and they'll make a change. But at the moment, why would they? Stock market's back up. They don't have a reason to change. So the only thing that's changed is price. It's not the data, it's price. And when the public sees price go up, they start buying. And that's, again, when the reversal eventually happens. These rallies are always retested at their bottom. There's always two bottoms. And maybe not the next day. There will be a point where this comes back down to its December lows. That will determine whether this is a potential buying opportunity. It's not, only because the Fed has to stop. I mean, they're destroying world dollar liquidity. They're destroying the money supply. The economy is clearly slowing down. Deflation is coming back. They're not going to stop. But when they do, maybe you get this interim bounce of 6 months. But the Fed does never, ever, ever backs off until it's too late. So with that, the content of this video is provided as educational information only. Is not intended to provide investment or other advice. The material is not going to be construed as a recommendation or solicitation by or selling security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre, own personal capacity, opinion expressed via that anyone do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial. So let's go look at some data, and I'll show you why the economic news is not better. And here you go. First off the bat, we've got the Atlanta Fed GDP now. So the Atlanta Fed has a, flash GDP reading of what they think is going to happen. Here's what their estimates have been. Look, the economy is going to grow between 2.5% and 3%. The green line, boom, 1.5% now for the fourth quarter. You want to know what this means for GDP growth? All of last year, after we had a massive fiscal stimulus to the tax cut, it means we're going to be under 3%. After we spent $1 trillion on tax cut, which we didn't get our money back on, we're going to have sub 3% growth. Well, the New York Fed confirms that. New York Fed, they have their nowcast report. And of course, there he goes. They're down to 1.08. That's not good. So once again, that's not what we want to see at all in this data. So let's go back and flip over to the PowerPoints, wherever there we go. And then we'll catch back up with some of those other things that I've got for you to take a look at. Promise will not disappoint when we get to what I want to show you. I'm pretty excited about. Money supply rolling back over, as I said it would. We're kind of catching into the heart of the government shutdown. We'll see that in some other data, and yikes, it's not good. Back down to 4.29%. This should continue to slide, and I suspect primarily will be not just due to the Fed tightening, but due to the government shutdown. The 6-month rate of change is down to 2.15% and falling, and the 3-month rate of change is 1.64% and falling. The growth rate decreased by 32 billion to 596. So we do expect this to roll over. There's no reason not to. Now, commercial industrial lending on a year-over-year growth rate, that should say slightly up to 10.09. But the magic of the doing things as you go, we can just go in here and change it, save it, And voila, hey, growth rate was up slightly at 10.9, but the back end number went from 1.09 to 1.05. So really nothing surprise here. Once this back end rate starts to move up, then you're going to watch this number go down. Looking at consumer loans, credit cards surprisingly didn't go up that much, up slightly to 5.42%. And this is starting, well, actually, you know what? I think I forgot to type that in. Well, anyways, it's flat. So I guess I didn't do a very good job with the charts this week. I apologize, but essentially growth rate is just stuck right here around this 5.24% range. It really didn't change, flat over last week. And again, without the consumer spending, which we know they didn't in December, which is unusual because it's a holiday month, it's not a good omen. Federal Reserve balance sheet increased by $2 billion for the week. However, this week, this was last week, this week it will drop by $23 billion, leaving them about $7 billion to go for January. Again, if you show me where the Fed bailout in the economy is, because it's not here. It's not here. There's no here. You want to see Fed bailout, Janet Yellen, all along through here. No stoppage of this train. Bank deposit growth, whoa, big drop to 1.24%. I mean, this is just how bad the consumer situation is, because we're starting to catch into the government shutdown data. And it clearly showed that consumers had to go tap their bank accounts. We knew they'd have to do that. And man, it just goes to show how cash-strapped consumers are. And that's not pretty. Okay, here it is. This is what I'm extremely excited to show you. This is a chart on world dollar liquidity, which I'd been renting from other people, so to speak. And it occurred to me one night, it's like, wait a minute. I have the data on the monetary base, and I have some data on foreign-owned U.S. Treasury securities. I bet the Fed's got it. There we go. Federal debt held by foreign and international investors. Boom, there's world dollar liquidity. And then I cross-reference this against other people's charts, and the only difference is mine goes back farther, which is cool. So here we go. Now check this out. World dollar liquidity on a year-over-year percentage change. So on an annual rate change, when it gets below zero, you tend to get, you do get recessions, except right here in 2016 when we should have had a recession and China juiced the global economy. They solved their debt problem by more debt, and they're trying to do it again because world dollar liquidity is contracting. And now it's at about a minus 8% growth rate. And here's the scary part of all of this. This is third quarter data. I don't even have live data because they don't update the foreign held treasury data, but every quarter. Now there is a place to go find some of it monthly, but it's not all encompassing. But fourth quarter is going to look even worse. And you want to know why? Oh, I bet you do. So I will show you. Check this out. Now this was posted on Zero Hedge. I was going to copy the charts, but I thought, let's just go here together. Foreign investors dump record amount in treasuries. Bingo. So you want to kill dollar liquidity? Fed tightens and foreigners dump bonds. That's perfect. And you can see in December, record selling, foreign investors dumped over $77 billion of U.S. Treasury in December, the most on record. And who bought them? Well, we already know the answer. The big banks bought it. So there's your first sign. Foreign banks dumped bonds. Now let's go and continue on what we see here. You see France is cutting, Brazil's cutting, Germany's cutting, China's cutting, everybody's cutting. Cool. And so with that, we know the assets and liabilities of commercial banks, they bought really big back here in December. I mean, it was big. I mean, you can just see Treasury and agency securities. There's almost $77 billion. You know the change between November, December, and then they continued going into January. Now, looking at the week ending in February 6th, we see they shed a little bit. But what's really notable is despite shedding, $6 billion treasuries, $3 billion of almost $4 billion mortgage-backed securities, and a couple of non-mortgage-backed securities. What's really notable here when we go look at treasury bills, they're falling, and that means investors or big money managers are going, I don't buy into all the stock hype. They haven't. These big institutional money managers have not jumped in this rally at all. They've just sat on the sidelines. The smart money's pretty much sat on the sidelines. They're buying bonds. The banks don't need to because the public's now buying them. But we now know the banks were buying up all those foreign sold treasury bonds. So that's killing world dollar liquidity. Now let's go back and look at world dollar liquidity. So this is really cool because now I can update this on a quarterly basis and we can track it, which is neat. So what this is telling us is we're in a recession, or we should be in a recession. If we're not in a recession, we're going to be in one real soon. because the fourth quarter today is going to show us going down more. What do you think the first quarter today is going to be even worse? Because the Fed's still tightening. So effectively what you are seeing, you want to know why trade is grinding to a halt. Why is Eurozone headed into recession? World all liquidity. Why is Japan's economy in the toilet? World all liquidity. Why is China suffering? Not the trade war. World all liquidity. Why is the U.S. data starting to fall? Because we're catching up to world all liquidity, and this is a bad omen. You can see the last time this thing went in deep into the toilet, we had an 80% decline in the NASDAQ that followed it. Now, the official recession didn't come later, but we knew the stock market was down. So this is telling us what is coming. Now, what I'm going to do over the long weekend is I'm going to go back and research these different points, since I can zoom in on my chart and kind of, see what happened when. And I'm going to go look at what asset classes performed the best. I think that's where the answer is at. That is absolutely where the answer is at on all of this. Because the other thing is, you say, well, we can't be in a recession, Steve. There's no way. Okay, here, look at federal government current tax receipts. Every time foreign federal government current tax receipts contract on a year-over-year basis, except right here in the middle of an expansion, there's either a recession has soon followed, or we were in a recession. So there you go. Look. All the hype that the tax cuts were going to pay for themselves, they didn't actually happen. In fact, here's the data. It didn't happen. This is the second quarter data. There's a third quarter data. The fourth quarter is going to be even worse, because we already know tax receipts are falling because the U.S. Treasury said they were. So effectively, we're in a recession. And, a lot of people don't want to believe that. Anyways, let's jump back into the PowerPoints. I think I've got a little more there. I think this is really cool because we've been talking about world dollar liquidity. I think I'm going to write a piece on that this weekend for next week, but this is everything you need to know. Now, really, what's interesting is we've looked at analogs before, but a lot of big money managers, big name money managers are saying there is a tight analog between 1937 and now. They think this is what is going to happen. So we see blue is the 1937 market, and you can see, other than this part right here, wow, look at that. And what it's telling us is the S&P 500, if this analog holds, it's got a big drop down. It's going to blow through its December lows, and I don't know if there'll be a buying opportunity, or if the Fed, the other side is the Fed did not really stop doing, they weren't as influential into the markets as they are today. At least, so they weren't in 1937. So there could be, this is what I think is going to happen, is this comes way down, and then you get a big bounce off of this when the Fed backs off. Maybe not. Maybe the thing just slides off, goes sideways and falls off a cliff. We'll see. But what this is telling us is the Dow is at 25,440. According to this, it's got to be down into somewhere between 17 and 18,000. And wow, that would certainly surprise a lot of people. Okay, so we've gone through the PowerPoints. We can get rid of those. We've gone through the web pages I want to look at. So what is left is let's take a walk down some charts and just see what we find. Now, just so you know, I like doing this kind of improv. I kind of looked at some of them. I didn't look at too many of them. So let's just take a look, see what we find. It's fun to do it together. Even though you're not watching it live, probably, but it's fun to do it together. So looking back at the S&P 500, let's zoom out and try to catch this whole range here. So it's broke over its 200-day. It's broke over its 50-week. We'll look at the weekly moving averages in a moment. Resistance, it starts to get into resistance right here around 2780, and the resistance just picks up. The big zone is up here at 2814. A lot of money managers have been saying I'm selling at 2800, or I'm going to go short. Part of the reason this rally has occurred is not just due to corporate share buybacks. It's because virtually nobody's left short in the market. All the people that have been shorting the market, the hedge funds, they all just gave up. They just quit. They said, it's not worth shorting. So it's interesting. So the market's not getting brakes put on it, but the data is showing this thing's got to roll over because the economy is just not in great shape despite what the narrative is. So there's a lot of resistance coming up here. There should be a retest of this bottom at some point. Here, let's look at the weekly moving averages, and we'll see. We got to close over the 50-week moving average. Now, in the past, a 50 close over here has not been good the following week. So we'll see if this thing can hold. Everyone's talking now, 3,000 and up and away. Doubt it, and I'll show you why. Because, of course, that's why you watch this. And here we go. The NASDAQ not confirming, just right over its 200-day moving average. Volatility was sitting was open today over its 200-day moving average. And look, 1, 2, 3 times it did. Bam, volatility took off. Why did you think these people came in and shorted volatility and drove stocks up? They did it because this thing was about to unwind. There's a lot of support for volatility sitting right under here. We can look at the ETF, which you should never buy for any reason. It's in this heavy support zone down in here. So maybe next week, volatility comes down to, say, 32 and takes off from there. It's probably not going to get back down this low again with the Fed unwinding. So volatility is not confirming it should be lower. Looking at the bond market is absolutely not confirming this at all. I mean, Treasury yields should be way up here or up here right now. And so when you see interest rates falling, it's a big non-confirmation in the stock market. And here's the shelf that this thing starts to get below, say, right around this 2.6, 2.615 range, 2.62. That's that big short squeeze starts to come, and that's what pulls all this liquidity back out of the market. So it's almost as if the big money is just letting the public, letting the speculators, letting the traders buy into this market, letting the corporations buy it, knowing that they're buying bonds and they're about to trigger this massive short squeeze, which will force all these people who have taken the last of their cash and gone back in the market with no cash to cover their Treasury shorts. Could be interesting. Looking at the long bond, the 30-year was, now this is even more interesting because when 30-year yields fall faster than 10, faster than, say, 5, that's a monster red flag in the market because something called an inverted yield curve. This is when long-term rates go below short-term rates. And this is dangerous because banks borrow short-term rates and lend at long-term rates. So if long-term rates are lower than short-term rates, effectively banks stop lending. So when you start seeing 30-year yields fall faster than 10-year yields, which are falling faster than 5-year yields, which are falling faster than shorter-term yields, massive problem. The banks are telling you there's a huge problem here, and you're not seeing it. So the bond market, again, is telling us everything we want to know about this equity rally, which is that the equity rally is bogus. It will not hold because here's the big shelf on 30-year, and it's sitting right around 2.9596%. And it closed back under 3 against probably everybody's expectation. And it won't take much now for this to get pushed down here, but it's completely at odds against this equity market rally. And another thing that's at odds with this equity market rally is volume. You're not seeing a lot of shares traded, so there's not a lot of selling going on here, not a lot of short sellers. This is just everybody sit back and saying, good, bid this thing up because I'm not saying we're going to short it. I'm just saying that people are going to short it. Now, I've got to have multiple conditions if we were going to place some short positions, and just saying that the market's high is not something a regulator would buy into. So volume is not confirming all of this rally. This is just a lack of short sellers and corporations trying to bid this up as fast as possible so they can get out. Now let's go on and look at oil and gas producers. Let's zoom this in a bit. And they traded below their 50-day, got up here. There's a lot of resistance right in here. So everybody's kind of excited today, rally on no significant news. I mean, let's face it. The government shutdown effectively being over is not bullish for stocks. The government being open for business should have nothing to do with stocks. Now, the government being closed for business should not be bullish. It was bullish, but it shouldn't be bullish because when the government shut down, there's just less money coming into the economy. So that isn't technically bullish. The Chinese trade war is not over, although they said they've kind of met an understanding on some topics. Kind of weird. But you'd think after a year of this, they would kind of have a clue of what the other side of the table was thinking. I don't know. They're coming here to Washington, D.C., as we've heard for the last year. It's going to be some great deal. Who knows? But unless the Chinese start buying a massive amount of U.S. Treasury bonds to offset the ones they've sold, plus the ones other foreign governments sold, plus the monetary base draw down, world dollar liquidity is going to continue to contract. The reality is Europe's about to be in a recession by the end of the first quarter. And if anyone thinks that we're immune to what's going on in Europe, nope, we're not. They think so, but we're not. So we have this little rally here off the soft bounce. I don't think this holds. I still think we get a retest of the double bottom. You'll notice that oil and gas producers are not confirming the S&P 500 at all. So that is a red flag. Now today on Twitter, Peter Brent, probably the foremost expert in classical charting alive today, he posted his data on gold saying, look, when this thing gets out up here, his data was a little higher, 1380, but we know we'll want to be in before that. He said, and maybe because he was measuring from a different level, but he's far more of an expert. He's been doing this for over 40 years. So we'll go with his data. I had my line somewhere up in here. He said the next major move when gold breaks out of this is up to roughly 1850, 1844.7. He said specifically is the move. Now this is very exciting because we know. So while we're looking at this weekly data, you'll notice that again, the weekly moving average, the 100-week moving average in blue is a sign of support. And you'll notice that even when it breaks over it's got to come back down here and bounce on it. So again, that does support that there is one final move down here at some point to bounce off of one of these either shorter term daily moving averages or weekly moving averages. Now, what does this mean for the gold miners? Spoiler alert, much better than I thought. So check this out. This is crazy. Look at the gold miners. Based on Peter's data, I had to revise this line higher, and he says it goes up to 60. He would say it would be up here in the $63-ish range, somewhere up in there. Where's my handy dandy calculator? So let's just say someone was buying in. We'll just say 23. And we'll say we'll say 63, and that is roughly 150+% return. I'm not going to tell you the exact return because it blow you away. That's called buying low and selling high. So the key here is what's going on with the gold miners. And again, they just got over their 100-week moving average, and they need to kind of reconfirm some stuff in here. We can see it on the shorter term scale on the year chart. It's kind of gotten a little ahead of itself. It's almost always tags one of these moving averages. So whether support is right here in this $21 range or perhaps down here in the $20 range, I don't know, but it's there and there somewhere. And one of the reasons is we know that the broad equity market's going to pull back. And we know the gold mining stocks have been moving higher with all this flush liquidity that's coming out of China. China is literally borrowing money to solve their borrowing problem. And they just pumped in a bunch of new loans this last couple of weeks. It's disgusting what they're trying to do there. It's not working because, again, world dollar liquidity is contracting because of Fed. And because they're selling U.S. Treasury securities. It's not, look, whatever they do is just not, it can't work. The math is not going to add up here. This is like 1 + 1 = 5. It does not work. So whatever they're doing is only temporary. It's going to unwind. So that's why I say there's a pullback, and then boom, there's your push in gold. 150+% return. Wow. Silver, I think, is a little bit better proxy. It's trying to get out of this resistance zone, which is trying to become support. It traded under its 200-day moving average, as I covered on my Facebook post this week. Again, I still think you see silver, the 100-day moving average had to come up to confirm this, but it's got to come down here at some point, make another confirmation. There's the validation we're looking for, and go. How cool would that be to pull off 150% return? I mean, wouldn't that be pretty impressive? I mean, I'd be impressed. I would. I'm not going to lie. Anyways, let's look at the U.S. Treasury bonds. We're on a 1-year chart. Let's go out to 2-year. This is a 7 to 10-year Treasury ETF. It's just sitting here it's just continuing to turn this resistance zone here. So this was resistance. It's confirming, it's turning it into a support because it went over, came back down into this resistance zone. So found support, tried to get over, tried to find support at the top, didn't, fell back in, and now it's finding support at the top. This is beautiful because as this 50-day moving average rolls up, and the 50 days calculating back to roughly right in this little blip here. So as these work themselves out next week, the 50 days is going to go higher. This thing's going to just probably go sideways until it connects, just tags off of it, and then you've got a lot of upside run here. You see the same with the long bond. This is a 20-plus Treasury ETF. The 50-day moving average is running higher. Here's the tail end of the 50-day, so it's going to these are going to drop off the averages and pick up these higher data points, and then it's got to get up. This line should probably be somewhere more in here if I want to draw it correctly. Looking at the Treasury yields, but it's got to get out over here, and then it's got room to run up into this potentially 130 range. I mean, a lot of upside in the bond market. What else do I want to look at? Wouldn't do any justice if we didn't look at the ags, which have been beat up like crazy. It's amazing. We've had the same news out of China over and over and over, and you get the same result. These computer algorithms, buy stocks, sell agricultural commodities. It's like, well, at one point are these things going to be so darn cheap that they're at their 50-year low? Oh, wait, they are. When you buy low and sell high, you got to find the thing that nobody wants and nobody thinks is out there. But when you look at, you know what, let me pull up something. I wasn't going to do this, but we'll pull it up anyway, see if... we had that big cold storm through the growing region. We're not getting any data out of the Department of Agriculture because they're not publishing data right now. But look what's coming, this massive cold front, and this is going to pass right through here again, all these crops that are growing. And again, this is the issue when it comes to solar minimums. You get this much colder than expected weather, and crops don't do well in cold. And so there you go. So we should see at some point that what I'm looking for is all these reports about crop production falling, crop and storage being damaged or rotting. Like soybeans, they do not store in depth. Like you can dry things like corn and keep them for a long time, but soybeans, they rot. I mean, they're not an indefinite hold. So the oversupply in soybeans, it could be being wiped out. And of course, I think there's a lot of pressure on Donald Trump and President Xi, not really sure how you say it right, but I think there's a lot of pressure because the Chinese economy is hurting. And President Trump today acted like, look how great things are here. But look, underneath the current, he knows that this data is not looking too good. He knows it. So there's a lot of pressure for them to both do something. And part of that something will involve China buying more of our agricultural products. That's like numero uno on the list of things that President Trump wants them to buy. And so you've got this massive amount of short selling going on. I'm talking like one of the most shorted sectors in the market, and the price is depressed. And so you've got nothing but upside potential here. And after dipping way down yesterday, prices moved back up. As you know, there are clearly defined buyers, right? And I keep undoing this line, but I keep having to put it back. There's a clearly defined group of buyers below down here in this purple line. They are buying all the way down under here. Every time price gets in, this is right under here, they're buying. That's what they're doing. So we know where the buyers are at. The only question is, when do you run out of sellers? And that's when you start getting a short squeeze and you start getting a rapid unwind of all of this stuff. And things start to come together because you get interest rates going down, bond prices going up. You get stocks coming down to set up a move back there. We get gold rallying so we can get in there and make return there. And then ags should start to take off at some point. And then all of a sudden it all comes together. And that's kind of what we're looking at. Now the market will be closed on Monday for President's Day, and I probably will be too. So there won't be an update on Monday, but I'm sure I'll be back Tuesday. In the meantime, got questions? Send me a call, send me an email. Here for you. Bye now.